So we're going to take a look, and I wanted you to see something here real quick with regards to the next crash. Okay, so I gave a class in late March, early April of last year for people who attended the Edge conference. It's a once-a-year event where we get together, we talk about some advanced concepts. And without going into too much of the theory, we had noted that we're following the course of the 2007, 2008 crash. And I wanted you to see some things based on that. So on the left-hand side, this is I want to use a weekly chart for now, just to match the two things up. And I'm going to go back, add a couple of zeros here, to the 2007-2008 cycle. Yeah, Earl, there's a GoToMeeting issue that I don't know how to circumvent. Okay, so I'm going back to 2007, 2008. And I want to note some dates with you. If you remember at the class, I told you specifically when I thought the crash was coming and why. The underlying mechanisms driving it, the electromagnetic influences, and all the stuff that we went into. And so this was back in March or April. And I made some pretty clear predictions about what was going to happen next. Well, I want to note a few things here. I want you to see where we are in relation to a few things. Let's pull this back. So here's March. We're going to just draw some lines. And here's March, January, February, into March. We're currently June 20th, July 20th, right here. Over here is June 8th. And over here is June 8th. Everybody with me so far? So the chart on the right is 2018. I can type at one point in my life. And the chart on the left is 2008, 2007 into 2008. Forgive me. Okay. Check it out. A, B, C. The run up. A, B, C. I'm going to call this drop. I'm going to call this drop. The market has a drop into this first period. It happened to be the all-time high this time, and we drop down in. Then we have a push up into B. We have a retracement, and then we have a stop run. Everybody with me so far? Okay. So in 2007, this is the eventual crash. This is the site of the crash in 2007, 2008, the Great Recession. Okay. Now you'll see as we scrunch up that chart, and then we scrunch up this chart, that there are a few similarities to where we are right now in relation to where we were in 2006 and 2007. Right? Gravy train on the way up. What I want to do is black this out right here. Can everyone see that at least structurally there's some similarity between what was going on in 2007 and what's happening in 2018? One of the things I'll do is I'll draw a line right here. This is June, July of the prior year. And this is June, July of the prior year. Now check this out. In June, July of 2006, I want you to notice this pattern right here. Early, see that double bottom right there? There's a up, there's a down, there's an up, there's a breakout, Dennis, there's a retrace to it, and then off it goes. Okay, so let's call this E. Over here, I want to introduce you to E, and you'll see the same thing. There's a push up, there's a push down, there's the low, there's the high, there's a retrace to it, a touch, and then a go before the drop. Now, here's the thing. If banks are following the same playbook, I want you to see what happens in a week or two. So this is 2007 on the left. Remember, there's a class on this. It's all recorded. I gave this prediction back in March of this year. And it's following exactly what I said we'd see. Here we are now, coming into July and August. So what's happening here? I'm going to, again, pull it out. The stop run candle has this sort of double top at the high at C. Well, in the previous cycle, I want you to see how big of a stop run that was. So there's the high. It was 6 3/4, 6 1/2, somewhere in that area from the B high. If this is in fact the high that they're going to run the stops on, then as of right now, we are $18 above that high. We're in kind of a critical area right here. Now, there is a significant difference in that 2007, the drop into A came from a lower high. In 2018, the drop into A came from a higher high. I get that. And I also know that it's dangerous to try to pick highs in an uptrend. But there are so many similarities between the patterns that one can't help but wonder if we're not coming into that same period of time here where it starts to roll off and disappear. What it's telling me is that somewhere in this area is the end of the train. Price-wise. Somewhere between 28.20 and 29.25 should be the point where this next recession starts to kick in. You'll also see that the next reversal point comes in here October into November. Middle of October, as we come into Halloween, seems to be the last juncture. Now, I just got off a conference with another customer. Matter of fact, I was supposed to send him an invite. Stand by. And we were talking about what would happen. What would they blame the crash on? Do you guys remember what they blamed the crash on in 2007? Let me grab this thing here real quick. There it is. Banks. Well, what specifically about the banks? And here's where things start to get really weird. In 2007, we had these mortgage tranches, and I'm not sure if I'm spelling it correctly. I'm probably not. There was a euphoric rise in the subprime industry. People were borrowing money that they couldn't pay back. People were borrowing money that they couldn't pay back. And this euphoria was enabled by the creation of this new instrument, these mortgage consolidation, what would they call it? Great Recession mortgage-backed securities. Mortgage-backed securities. It was a new instrument, Earl, that no one had ever heard of or really understood how it worked. Is that a fair estimation? Nobody really understood what was going on or how it worked. And it created a euphoria. And then the reversal started to occur when they created an instrument to short the mortgage industry. And if you've seen the movie The Great Short, you understand how Goldman actually, the guy who created the tranches, actually created an instrument to short the mortgage industry as it was going up. There's a huge controversy. Here. Goldman puts mortgages and naked shorts behind it. How Goldman won big on Mortgage Meltdown. We made money betting against the mortgage market. So there are some similarities here. And I thought, what are they going to blame this next reversal on? And it occurred to me, Bitcoin. Earl, this is another one of those mysterious instruments where no one really understands how it works. And if you remember, people were getting mortgages and borrowing money inside of the environment created by this promise of instantaneous wealth. Earl, you buy a house, it's going to be worth double that in a couple years. This market is on fire. Remember that? Does everyone remember what was going on 11 years ago? You're in the real estate industry. I'm sure you remember. You probably had phone calls every 10 minutes from different brokers. Earl, I want you to get involved in this property. This place has tremendous potential. You got this and that. If we just get in there and flip it, you're going to make 80 grand in a couple weeks. Well, that same hysteria happened when none of us was looking. Right around the time Bitcoin was near its all-time highs. What were people doing, Dennis? People were taking out mortgages, second mortgages, to buy Bitcoin. In fact, what we're seeing now after the fact is that a lot of people took out mortgages to buy digital currency. You didn't hear much about it, did you? It's not something they reported on with CNN. But right around the $8,000 mark, $10,000 mark, people started putting money into the market. So imagine you're buying Bitcoin at $8,000 and $10,000. You're on this mania curve. At some point in time, there's got to be a leveling off. Well, here's the thing. I want you to remember the cycle. There's a mania phase, and then Goldman steps in to short it. Okay? If you look at the Bitcoin in relation to what we've been talking about, they couldn't short Bitcoin, Earl, could they? Because it was a cryptocurrency. What did they have to do to be able to short it, guys? How do you start the panic? The banks didn't have access to it. What do you have to do? You have to create an instrument. You have to create a way to short it. A brand new method, a brand new market. So in 2007, there was no market to short the mortgage industry. Goldman created it. The banks created the means to short the high of the market they were running up. And so they opened up a market on the CME where people could buy and sell Bitcoin. And from day one, remember where people started to purchase, right? Right around the $8,000 and $10,000 mark. So right over here in this price, according to the other articles, this is where people started to take home mortgages out. You see that line, Dennis? Let's do 10,000, somewhere in this region. All right, we'll do a couple lines. This is where people are taking home mortgages out. And you can see these, the last people to the party, right, Dennis? This is where we bought it last time, and it went up to 20,000. And Earl, right here is where the last people lost hope. So this area, in my opinion, is where Goldman Sachs has all of these trapped consumers, people who've mortgaged out their homes, and they've come in here and doubled down. It's going back up, sweetheart. I don't know. It seems very risky. That was such a big drop. It was up that high, Earl. It was up that high, sweetheart. It's going back, I promise. You know my mother was right about you. Shut up. What did you say to me? Nothing. I love you. You're amazing. So, Earl, I see the hallmarks of the banks luring people back in one more time. Now, what happens when you have 2 mortgages and 3 mortgages on your home? What do you start to do when your mortgage payment, Earl, went from $1,800 to $3,600 a month? Anybody? What starts to happen when you can't pay your mortgage? Dennis says you leave the keys on the table. Oh, Earl says you leave the keys on the kitchen table and move. You remember this. Earl, how long does it take to start foreclosing and get somebody out of a property? It can take a year. Okay. So I Googled, how long does foreclosure take? The notice of default starts the official foreclosure process. This notice is issued 30 days after the fourth missed monthly payment. From this point onward, the borrower will have 2 to 3 months, depending on state law, to reinstate the loan and stop the foreclosure process. So it's a month or two. It's 4 months of missing payments, and then 2 to 3 months to get them out. So about 6 months before this thing starts to break down, right? So if you didn't cash out and you got in right here and it came back down to the price that you bought it at, that was February, January of last year. And remember, they're going to have a movie about this. And I want you to remember you saw it here first. We had no idea. No one really understood what these cryptocurrencies were doing. And then we're going to find out that banks were investing in them as well and pumping them up. And we had no idea. Okay. Well, Earl, what I want to start to do is I want you to see that right here was where people had a strain. Would you agree that, Earl, from here to here, there was a strain on anyone who took a home mortgage out to buy Bitcoin? They didn't have gains, they had losses. So you got a house in the Bay Area. You bought it at $1.5 million. It's at $2 million now. You got $500,000 in equity. Bitcoin is at 20 grand. You buy 100 grand, 200 grand, 300 grand, 400 grand worth of Bitcoin, and it immediately starts to drop. Now the housing prices level off. You start to get upside down in it, and you've got $500,000 in secondary debt. Earl said it involves a limited number of idiots. Here's the thing, Earl, we have no idea how many people are involved. Earl, do you know what's better about this time around than the second time around? It's untraceable. There's no fingerprints. There's none. Who are they going to blame? Who are they going to blame this time? Who should have been watching that cryptocurrency market, Earl? We need regulations. You're going to blame the government. How do you know if this is happening? Ready? Again, let's just go back, and I want you to see the charts. How do I know if my theory is correct? If people don't have enough money, what's the first metric we should start watching? If you have your home mortgage and you have your second mortgage, and not bankruptcies happen later, what happens first? What can we measure? Can measure consumer spending. You can't buy things with money you don't have. Well, we can actually look that up. Consumer spending 2018. CNBC, April 27th, 2018. Weak consumer spending is seen restraining U.S. growth in the first quarter. Well, wait a minute. I don't understand. We have more jobs. We have more growth. Look at this chart, Earl. Look at that. Market's at all-time high. We should be rolling in cash. People buying a second and a third home. What is this weak consumer spending? Why would it slow? Auto loans. Auto loan. Rising interest rates, headwind for 2018. Here's another one. Many of us appear to be missing payments. 4.1% of active accounts were delinquent 90 days or more at the end of 2017. People are starting to not make car payments. Huh. What I'm trying to say is, Earl, they're setting it up. They're setting it up. And if I look at this chart, the crash, the first wave is either here in the next 2 weeks or it's over here. That's all I'm saying. If, I want you to pay really close attention to what I'm about to say. I want you to look at the inflection points with me. Ready? The inflection point here is the week of August 20th to the 27th. The inflection point here is the week of August 17th. And then the following inflection point is October 12th. If for some strange reason the market continues to rally up through the high, Earl, it will rally up through the high until the middle of August, and then it will drop. Are you with me? If it's not dropping, if we're not back down into in next week or two, we're not back down below this low, we will climb until August 17th, the middle of August, and then we will drop. They are following this pattern, these inflection points, like a quarterback following his coach's plays. And I believe we're coming into the end of the run right here. They will look back and they will say, nobody understood the instrument. It wasn't regulated. We need more regulations. We were overextended. Then we'll start to find out that the banks were investing in the cryptocurrency the entire time. And now we just need to bail them out again. So that's my perspective on that stuff. Whether or not it plays out, I can't tell you for sure. But I can tell you that everything right now is lining up exactly the way that I said it would in March. And we're running out of time.